Good morning, everyone. Welcome to this update for global stocks and commodities for the 26th of November, getting close to Christmas. Markets remain on track. It was a shortened week in the US with Thanksgiving holiday, but really no change. Just a continual, slow, steady, grinding higher, and the S&P index closed above 2,600 points, which seemed virtually impossible 12 months ago. And it really goes to underpin a key point that I want to make about how we think about the market and how we manage risk, because it really is such an important topic. How we manage ourselves is even more important than how we manage our investments. So let's jump into it. In this update, I just want to touch on some of the key principles of getting the right sort of balance between leaving yourself open to the gains that the market provides, but also adopting appropriate risk management as well. And that really is a battle between the ears, I can assure you. Stock and commodity trend update, of course, and portfolio analyst last week. I got, again, some great feedback. I introduced a very reliable trend pattern that can open you up to some very significant long-term gains. And there was also a couple of good buys as well. Now, just on the topic of how to manage a bull market, because this bull market has been running now for a long time. The longer it goes, the more the dissenters drag out the statistics that, this has been the longest period of time and it's the greatest number of points advance, and they drag out every statistic that you could imagine to demonstrate that this market just has to turn around and fall over anytime soon. And it creates a difficult environment for investors, because naturally we've got these unconscious biases, we've got these voices in our head that really want to buy into that argument that because a market has been going up for so long that it must inevitably fall over. And last week I showed you a couple of really graphic charts that really explode that myth and indicate that really on a big picture level, we could be close to the start of a major trend rather than basically on the precipice of the end, particularly with the NASDAQ index. So it's really important to be clear about when to cut losses, how to do it, when to do it. When to take profit is my experience of 15, 16 years of working extensively with traders and investors in the market. This is the one that creates the most difficulty. When to take profit, and just how to manage the exposure. So that really is the battle, and the answer to it is just to be clear about what you're doing, clear about your plan, clear about your purpose. And I make this point often. You can pre-plan your response to any kind of market outcome. You can think it through before you place that investment as to what your response will be if the market does A, B, or C. So there is nothing to stop you from doing this. The only reason that most people don't do it is because I think, frankly, we're just a bit lazy. We don't want to sit down and actually go through that process. But most aspects of the market are within your control. You can control how much you risk. You can control your exposure. You can control which stocks you buy. There are many things that are within your control. The day-to-day fluctuations of the market naturally are not within our control, but we can control all the things that go around that. So you actually have far more control than I think what most people are aware of. Turning now to American stocks, the S&P had a pretty good week, was up nearly 1%. Look, earnings are good. The economy is sound. The economy is sound in Europe. And Japan is solid enough. China is solid enough. We've really got a global synchronized expansion going on, and earnings are responding. The S&P was above 2,600 points for the first time, and I've been pointing to a little bit of a wobble in the junk bond market and how that was something I was watching very closely. Well, we got a rebound last week, so it would appear to be at this stage yet another little false start in the bond market, and we've been seeing those now for probably the last 3 years. The other thing that also makes me continually confident in this ongoing trend is we are still seeing, they're not great, but there is a small rotation of money from stocks into bonds. And while that's occurring, we're nowhere near the top, because tops get formed when everybody starts to charge into the market and everybody starts to believe that the market trend will go on and on. And we've not seen that since 2009, and we are still not seeing it. The Nasdaq, and within the Nasdaq, the technology sector in particular, remain the clear leader. They're the leader in earnings by a significant margin, and they're also obviously the leader in price, as we'll see from the Nasdaq index. Now, the US dollar weakened again as the market tries to second guess what the Fed will do in a few weeks' time about the December rate rise. You would have to think that a December rate rise is far more likely than not, and that should provide a little bit more strength into the US dollar. So let's take a look at some charts. We'll start with the S&P, and you can see here's where we were in the middle of the week before last. We'd had a bit of a dip. We got down to a low of 25.57, but the market continued to advance, and we closed just a point or so off the all-time highs and above 2,600 points for the first time. So there is just no change. There is no change in character. You see the range, the daily range of the candles is quite modest. Most of the closes are near the high of the session. There is just absolutely no indication there at all that the market character is changing. Let's look at the Nasdaq. We'll look at the QQQ, which is the ETF tracking the Nasdaq, and you can see it's starting to get a little bit ahead of itself in relation to the 50-day moving average, and that often brings this sort of bit of a sharp 1 or 2 day down. We saw it here. That's probably the last couple of times we've seen it, but just continuing to power on. And within the technology sector, so Nasdaq is the strongest, technology is the strongest sector within the Nasdaq, and the strongest industry group within the tech sector is, of course, semiconductors by a very significant margin. And if you haven't had exposure to semiconductor stocks, then you've been underperforming the market by a pretty big margin. And certainly in my main membership services, we've had some good exposure to semiconductor stocks. Now, just looking at the Russell, we had some weakness in the Russell here that turned around with a really nice reversal on the 15th of November. Right off support, so behaving technically very well, and the Russell is now basically back at new all-time highs. So no problem there at all, and that of course has led to a rebound in the market breadth, which was starting to look a little bit frayed around the edges, but we're certainly back on track with that index as well. US dollar, we've had a nice rebound, and we're now basically retesting this support line. We've got a declining trend line here, which could still come into play, so I don't write off the possibility that we could again decline if the Fed don't raise interest rates. Then we could see a sharp move down, possibly down to 89.5 from the current level, which is around 92.5. But it's also likely that this support level here will hold. So far we've done an exact 50% or 61.8% retracement. So it's possible this level could hold and we could head higher from here if we get a rise in US interest rates. This is the market breadth line. The blue line is the S&P 500 index. The red line is what's called the cumulative advanced decline line. So it's showing basically the level of the breadth of the market. So how many stocks are advancing as opposed to those that are declining. And you can see there was a little bit of a dip here. The two lines diverged a little bit over the last few weeks, but you can see that advanced decline line, the red line, has really kicked up in the last week. So that's a good sign. Market breadth very much back on track. Aussie stocks, our dollar edged up a bit with that US dollar weakness, but we are underperforming most other currencies. Those support levels at 73.5 and 71.5 still hold. Our index managed to gain 25 points on the week, but failed to regain the 6,000 point level. And I know I say this most weeks, but look, if your investment focus is the top 50 or 100 stocks in Australia, again, you are significantly underperforming the market because the reward for risk is just massively better in small and mid cap stocks, the high quality stocks, the growth stocks. It always has been. The long-term statistics show that. I don't know why most investors still continue to just think about owning the banks and the major stocks, thinking that that's where the safety is. I can assure you that well-selected small and mid-cap stocks are no more risky than the big stocks, and the return is light years better. So you've really got to broaden your scope to take that part of the market into account. Just a few other of the global indices I want to look at. This is the German DAX. This is on a weekly chart, so you can see we've got a strong advance. There's no question about that. 3 or 4 weeks ago, we were setting all-time highs around 13,500 points. We did have a 2-week dip, but we got a recovery last week, and that's certainly consistent with how the German economy is going. The FTSE in London is really caught in a bit of this is a daily chart. Just for consistency, I'll switch that to a weekly chart. So you can see we have got a consolidation range here that's been in play now for about the last 6 or 7 months. So not a lot of change in the FTSE, but given what's going on with Brexit, it's pretty encouraging, really. You could have made an argument that with Brexit, that the stock market would be significantly lower, and many people did. So they're the main overseas indices. This is the Australian index. So a big washout 2 weeks ago, a little bit of a limping recovery in the Australian market, but look, there's just not a lot happening there at all. Turning now to precious metals while I'm here. Not a lot of movement on the week. Gave up $5, which was really just pretty much on the last couple of days. This is on a weekly chart, so you can see there hasn't been a great deal of movement there in the price of gold, and nor are there really reasons for that to occur. This is GDX, the world's main gold ETF. On a weekly chart, we're still in this wedge pattern, and we're still really not getting any traction at all to look as though there's a breakout. So that's on a big picture global level. So gold dropped $5, and the environment for gold rising is just not there. There's not the fear. There's not the inflation. The main drivers for gold are really just absent. So one would just have to expect that gold is probably just going to sit around about where it is. Now, there's no traction globally with precious metal stocks, as I was saying, but in some areas there are some good gains. And last week I made reference to what I think is Australia's best gold stock and quite possibly the world's best gold stock, and that's Northern Star Resources. So there are a few pockets of good gold stocks, good gold producers. But I will just make a comment. There's been a speculative gold rush in Western Australia with companies, small companies. They're only developers and explorers. and they've been rising in price by 100%, 200%, even 300% in some cases. It's an absolute speculation. It is incredibly dangerous, and extreme care is advised. I think that sector has been completely overblown, and if you buy into that, you've got a good chance you could see 20-30% loss in a single day. So just be extremely careful in that sector just at the moment. Turning to other commodities, copper rose to $3.16. That's really just currency related. But crude oil did bounce back hard. We had a bit of a decline the week before, but we back almost to $59, which is the highest in 2 years. So much more positive signs. And the bigger picture, as I indicated last week, is that there's a target, technical target, just a little bit above $60 initially, and then over the next few years, this I'm speaking technically here, not from a fundamental point of view, but from a technical point of view, big picture level, that you could certainly make a case for significantly higher oil prices in the coming years. There's the spot copper chart with the rebound. Here's crude oil over the last 3 months, but particularly in the last week, you can see how much it kicked up from around $55 up to almost $59. So quite positive. Interesting though that oil stocks haven't really boomed with it. So I think people are still a little bit circumspect about the sector. So to wrap it all up, it's really important not to overthink a bull market. And I do get questions from members quite regularly about when to take profit. And I have a very clear methodology that I use and I recommend to everybody about how to take profit. And I think the important thing is don't overthink it. Stay with what is. Trade what you see in front of you, not what you think should be. Don't try and anticipate the tops, because people have been calling tops in the NASDAQ now for well over 12 months, and the NASDAQ has advanced enormously in that time. So just act on the charts, and there are no signs of impending gloom in the charts as we've seen. Portfolio analysts this week, going to be looking at opportunities in artificial intelligence. The session last week was so big I had to hold that one over. And there's also a couple of strong buys as well. So if you wish to avail yourself of the 2-week free trial for Portfolio Analyst, I think you might find it extremely enlightening. There's my contact details for anyone wanting to get in touch with me, and I'll be back with you next week. Cheers.